It's official. Cisco is laying off 6,500 workers and transferring another 5,000 workers in a sale of one of its biggest plants. Reports of impending layoffs have been circulating for weeks as the networking giant looks for ways to slash $1 billion in costs. Cisco's stock price has tumbled more than 32% over the last year. Cisco expects the restructuring to cost $1.3 billion over the next several quarters. Now, of the 6,500 jobs being cut, 2,100 of those workers opted for early retirement, reducing the company's workforce by about 9%. Some analysts had called for as many as 10,000 jobs to be cut. And to that end, Cisco is also selling its Juarez, Mexico set-top box plant to Taiwanese electronics manufacturer Foxconn. The terms of that deal have not been disclosed, but the sale is expected to close by October. That facility makes video and telecom equipment. Now, for insights and perspective on the Cisco layoffs, let's bring in Alex Henderson of Miller Tabak. He now has a buy rating on Cisco shares and has a $21 price target on the stock. Alex joins us now from New York. And first of all, Alex, you had suggested layoffs could be as high as 10,000. Is 6,500 enough?
Well, that's a great question, Emily. I think the big challenge you've got here is you've got essentially flat revenues. So taking out 6,500 people plus the elimination of the Juarez facility goes a long way to stabilizing the margins, but it's not enough to solve the basic fundamental problems. And I think they're still very heavily challenged on the top line, which ultimately will determine whether the stock can move up or whether it'll just hang in here. One thing it definitely does do, though, is it puts a floor underneath the shares.
So what are the fundamental problems, and what else do you think needs to be done?
Well, the biggest problem they have is aging end market. The switching market is a fairly mature market. It's a category that has had good, solid growth for the company over the last couple of decades, but at this point, most of the innovation is moving to other areas in the network. And as a result of commoditization in that space, combined with increasing competition, they're seeing pressure on their gross margins, and they're seeing declines in revenues within that big segment of the company. Offsetting that is going to be difficult, and offsetting the margin pressure associated with the move to lower-end boxes, that negative mix shift is also going to be pressure that's going to be tough to absorb. So they've got a problem. You're looking at revenue this year in the July quarter is essentially flat on a year-over-year basis. Forecast to be up 1% quarter to quarter, and that's just simply not enough for a company of this size. They need to get that top line growth up into the 5 to 15% vicinity in order to be able to produce leverage off of these cost cuts, and I don't see that happening near in.
Now, what about John Chambers? At what point do investors lose confidence in him and think maybe someone else is better for the job at this point?
Well, it's a really good question. The problem that Cisco has, part of it is self-inflicted. The company's done a number of acquisitions that were misplaced. The most egregious example of that was the Flip acquisition, where they bought essentially a commodity camcorder product which didn't fit in their line and paid a top dollar for it and then turned around and wrote it off. There's been a number of acquisitions like that. So this tends to take the company away from its core and away from its roots. And they've done things that have distracted them from executing on their core strategy as a result. That's Chambers' watch, and he's got to take responsibility for that, I'm afraid.
So what specific things does Chambers need to do to right the ship and restore confidence?
Well, certainly they've done a number of things already. For instance, they've introduced a lot of new products over the last 6 to 9 months. Those products should start to give you a little bit more traction on the top line. But more importantly, they need to cost reduce them to get the margins back up, and that'll allow you to give some leverage from these cost cuts. This cost-cutting move buys you some time, but it doesn't solve the problem. So you've got about 6 to 12 months. If you don't get it solved by then and get the top line going, there'll be more restructuring charges down the line.
All right, Alex Henderson of Miller Tabak, thanks so much for joining us. This is a story we will continue to follow, including what jobs are being cut and where exactly those jobs are.